Welcome everyone to the session. Thanks for joining us. And I'd like, of course, first to introduce the three largest small business lenders in the UK, or representatives. On my far left is Kim Kinnaird. She's head of the customer relationship team for SME banking at Lloyds. In the centre is Richard Kerton. Richard is a banker with RBS NatWest for 25 years plus, but more recently is the head of Esme, the bank's online lending platform built on technology which has been licensed from EasyBob, which of course is a pre-existing direct lender. And on my immediate left is Samir Desai, who is CEO and co-founder of Funding Circle, the non-bank. I'd like to start by asking the three of you to talk to me a bit about what's happened to the customers in the last few years, in the years since the crisis. We've obviously seen a hell of a lot of financial innovation. We've seen brand new companies appear, but we've still got small businesses that need money. So what are they doing differently now, and how have they evolved? Kim, perhaps you could start us off there, please.
Thanks, Andy. I think in terms of what we're seeing in the client base, I think their hooks and their proof points are changing. So their personal experiences are now becoming their proof points for how they want to deal with us as banks in business. And that's clearly driving a much greater demand for seamless origination in a digital environment for lending, speed of execution and also credit decisioning. But also I think since the financial crisis, whilst absolutely ease and convenience and speed are elements, SME is a broad church of clients, so we serve clients up to £25 million turnover in the Lloyds SME business, and those clients at the top end of the book are very complex and can be more like MSB clients. So we mustn't forget that broad church needs to be served, and I think speed, ease and convenience are absolutely where we've seen real innovation and real drive, which is fantastic and needed. But I also think there are two other factors that clients are just as interested in, and that is trust, and also it is around financial terms. And I think clients still value that. And if we look at what we're seeing in the market today, where you've got brands and trusted brands that have scale, that have also got proven track records through economic cycles, and that is also a driver of what enables us to continue to be very relevant to those clients. So I think that is as important as the innovation that's taken place. It's not just about those simple changes around speed execution.
Okay, thanks. Okay. Richard, you of course have looked at the customer through two lenses, as a banker in RBS NatWest and now as the head of an online platform serving the market. And could you talk to us a bit about the different perspectives those two seats give you?
Yeah, I think I completely agree with the fact that SMEs are now looking for quicker decisions, a speedier service, less friction in the customer journey. I think what you tend to see in a traditional banking model is a sort of very heavily filtered customer lens, because you go through multiple layers. The customer goes through multiple layers before it reaches a decision point. Whereas in a lending platform, you see everything. You sort of see it completely naked, warts and all, and you really get some really good insights from what customers are looking for in the marketplace around the types of journeys. And I think it's decision and frictionless, and not just frictionless, but it's the amount of information, just providing the information that they need to provide rather than lots of information that traditional banks tend to ask for. I think also within the SME sector, there's more choice than there ever was since 2010. And customers are using multiple sources of finance now, more so than they ever were, to sort of meet their solutions.
And just out of interest, how quickly are you processing people through to a decision point now on Esme relative to, say, Kim at Lloyds?
We can process a customer in around about 15 minutes and fund them within another sort of 10 to 15 minutes.
Right. So that's terribly slow. And Samir, I mean, if I were being super charitable, I would say that quite a lot of the change in expectation has been because of companies like yours and how fast you enable people to transact, and also the flexibility you gave them. I mean, do you think, is there a real shift in the centre of gravity, or is it just at the sort of small end of small business where that is really going to take hold?
What we're finding, for those of you who don't know, Funding Circle is the largest online small business lender in the Western world by loans outstanding. So we have about £1.8 billion of loans outstanding, which we think is bigger than any other platform. Obviously, if you go to China, there's lots of people bigger, but in the Western world, we're the biggest. We're seeing a lot of the same kind of stuff that these guys are seeing. So businesses at the end of the day want faster, better, cheaper loans. They want speed and convenience. They want to access it in the way that is most comfortable to them, which increasingly looks like on mobile, things like that. They want better levels of service, and they want the lowest cost loan. They want to match their business lives to their personal lives. But I also agree with a lot of the stuff around trust. What we're increasingly seeing is that a lot of businesses like interacting with us just because we're not a bank, actually. We've said many times that we think there's going to be space for banks and platforms. I think there's been a growing up definitely on our side, and probably we're less insignificant than we used to be to banks as well. And there will always be businesses that want to go into physical stores or branches and do stuff that way. But there's increasingly a large portion of businesses we find that want to interact with a brand, have an experience that is just away from the bank, and that's why the stuff at Esme is so fascinating, because and we're trying to figure out what it really means, and maybe you can tell us, Richard. But on the one hand, you could say, well, small businesses. This is a bank recognizing that, putting a brand outside the bank, trying to actually capture those customers that don't necessarily want to go to a bank. On the other hand, it could just be a massive corporate fudge, and we're just, rather than realigning the whole bank to improve the experience, let's just stick this thing on the side and not really invest too much in it. So I'm as fascinated as everyone to hear what Richard has to say.
Okay. Well, that obviously begs a couple of questions. One of which I think is relevant, Richard, if you don't mind, is if I, as a small business, approach Esme or walk into a branch of NatWest, is there any difference in the risk appetite to lend to me, depending on who's doing the lending? Do you look at propositions that the bank would feel less comfortable with?
Yeah, Esme is currently in a pilot phase, and we've deliberately sort of set it up separately to the organisation. So as far as the customer is aware, they're sort of applying to Esme Loans Limited for a loan, and we do currently have a different sort of risk appetite for that particular business. I think from our perspective, it offers huge opportunity for us to get really good insight into the way that the small business environment's changing and moving, and the way that technology is being utilised to provide customers with an improved, speedier, less frictional journey to access funding. And in terms of how the marketplace is evolving, the financing arena is evolving, it provides fantastic insight from all those perspectives. And that's sort of how we're looking at it at the moment.
Yeah. So to summarise, you're kind of taking a little bit more risk in order to learn something in a market you're not otherwise in.
Yeah.
Right. Sorry, Kim, slightly devil's advocate question for you as well. If I'm, as a personal bank customer, I don't really merit any kind of relationship management until I become significantly more wealthy than I am today. How much relationship banking actually survives in small business banking? You're head of a customer relationship team. How much time are you spending with the guys that are borrowing from Esme and Funding Circle, people of that size? How much relationship do they get?
So I think in terms of the way in which we structure our business, there is a broad spectrum. So those that absolutely will have one-to-one relationship management at the top end of our book, where we're looking at those very large and complex clients. At the smaller end of the business, there is less face-to-face relationship management in terms of cost to serve and ability to deploy that effectively. You just can't do that in this marketplace. I think what we have, though, done in terms of being more relevant to those clients and giving them that experience. It's making sure we've got the tools to equip them, to give them insight, to give them value add, so they can understand how they can better exploit their own business and be more successful in their own market. So I think in terms of our ability to do more with them, whether it's online or over the phone, and we're doing lots of experiments at the moment in terms of the use of web chat and being able to have conversations with clients, you can make that relationship management experience come to life, even if you don't have somebody sitting in front of you in your office. So I think it's absolutely possible. I think, though, I come back to absolutely it's about removing friction in the process, absolutely it's about speed and ease and convenience. But I think where there is more opportunity for financial services is around the value add. So actually, a lot of our smaller clients, they're the ones that need the most support, because actually it's not just about they suddenly wake up one day and say, I need a £50,000 loan. Is a £50,000 loan what they need? It may not be what they need. What they need is more access to better working capital solutions, or they need to understand how they can unlock more through their own business, through better management. That's where we need to evolve alongside being able to just provide product, because product's product. Actually, it's about an end-to-end client journey. What does the client want to achieve? And if we can support that, that's where we'll win as financial service providers.
Right, thanks. Let's talk a bit about origination, about where this business is coming from. And again, part of it comes back to people, because obviously platforms do get direct business, and I'm sure you'll tell us how much, but they also rely a lot on brokered business. And what about the roles of those brokers? I mean, how much brokered business are you now doing, Samir? How much of your book is brokered now?
I don't know if this one works. Sure, so I think there's a bit of a myth about platform SME lending, that it's majority broker. As the largest platform, I think we're about 75% direct business. We do work with brokers. It's an important part of the business. As I said, there are certain types of clients that want to access finance through those means. But actually, the majority of customers we're acquiring or are coming to us directly, which again speaks to the difference in philosophy in many ways. I think obviously I agree with a lot of what Kim said, but on our side, it's really about simplicity. It's very, very hard. I had a look at a few bank websites this morning just to refamiliarize myself. I mean, it's very difficult to find even where to apply for a small business loan and then actually navigate your way through all the different products. There's so many different products. It's complicated for even me, and I run a lending platform that's doing something similar. So what we're doing is really simplifying the entire experience, trying to provide great service, all that kind of stuff. But really trying to take it to a product that small businesses want and need. And I think we estimate that we're about 2% of the total market, by outstanding loans. But based on Bank of England net lending data, we think we're about 40% of net new lending. So that's a measure of lending less repayments in the UK, a measure of market share. Mm-hmm. So, or how you're increasing market share. So I think increasingly customers are turning to this very simple, easy way of doing things, and don't necessarily want to go and be cross-sold 50 different products in a branch.
Thanks. I mean, Kim, just to look at it from the other end of the telescope, from the bank end, I mean, would I be caricaturing terribly if I said that actually the most important origination tool for you is the current account?
I think that would be a caricature, yes.
How so?
I think absolutely, in terms of having an active client base with current accounts, yes, that's we come from a strong base in which to build relationship. But we do an awful lot through customer get customer, particularly in the SME business, significant switcher activity through that. We have an element of broker business that we will do, and we've launched a new innovative approach to broker relationships to bring together all core parts of brokering. So it's not just about lending; it's being able to offer a much broader product range to clients to help them serve their needs. It's not just about where the current account sits. But I think, I agree with what Samir's saying. There are absolutely clients out there that want a different experience, and the client is going to demand, and therefore that's where the market will move, I think. But I think it's not just one thing that clients want. I think there's a broad spectrum in terms of client need and actually kind of the servicing requirements that those clients will have and what they'll value. Some will value price more than anything else. Some will value ease and execution. Others won't. Others will value other aspects in terms of relationship or what they can draw down on in terms of that relationship with their service provider, their financial service provider.
Well, clearly one of the things that really has emerged in the last few years during the time in which Funding Circle has grown and Esme has appeared is that unsecured lending is becoming a much more sort of core central product for many, many more businesses. Of course, that's the only product you actually offer, right?
We do some secured loans, but it's mostly.
Basically, but you've sort of announced the end of property lending, so you're essentially... So, and obviously, if you're lending unsecured and you can process the data fast enough, as Richard says, you can execute very, very quickly, which basically means you can almost turn finance for small businesses into a utility. I can just turn the tap. Is that the reality of the future of small business finance? In other words, are there going to be lots of different products, or is there simply going to be an availability of cash, which if I have the right data and the right credit profile, I can access in 15 minutes? Do I need lots of products, or is there just a tap of cash? Samir?
No, I mean, look, I think it's too simplistic to say that it's all going to move to something like that. Like, for instance, there are lots of customers where invoice finance, for instance, might be a more appropriate product. So a customer that might not have a long track record but trades with people like Amazon, Tesco, a bank can offer them a good product. Equally, there are some advantages to leasing, commercial mortgages, things like that. I think the emergence of a larger market for unsecured loans is firstly because no one really offered it, to be honest, before. It was offered, but not to very large sizes. And also, not many people know, but in the UK, if you want to do a secured loan to a business, what you have to do is you have to go to your bank and agree what's called a deed of priority, which basically means you have to draw up a bespoke legal agreement that allows you then to lend to that customer. And the few times we've tried to do that on secured loans, hey-ho, the bank actually offers a loan as well, because they've got 2 months to figure it out. So it's a massive competitive advantage that does push people towards the unsecured space. That's not to say that now we've been able to prove over a long period of time, 7 years, that we have a very good track record of delivering these loans, very good recovery rates, very low loss rates. But other markets, for instance, like the US, have a very simple system where charges are filed online and people just rank in order of when they file charges. So actually there's a much more vibrant secured lending market in the US. In fact, that's predominantly what we do in the US. So I think you'll definitely have lots of different products, and the UK system has been set up in a way to encourage unsecured lending now, which is a shame.
And Richard, I mean, as Samir said, I mean, some years back, a lot of small businesses would have had trouble getting their hands on an unsecured sum of north of about £30,000-40,000 maybe. You're prepared now to look at loans bigger than that. Why do you think banks have historically not really want to go there?
I'm not sure whether it's that they didn't want to go there. I think it's just the way that the banks evolved over a long period of time, and often, the debenture that was referred to earlier, the mortgage debenture, almost, as a new business, small business sort of went to a bank and got a current account and took on their first piece of lending. That was almost the path that got followed, and that's how the banking market evolved over decades. And the unsecured market has developed because small businesses have demanded a diversity in their lending and in their products, and the platforms such as Funding Circle have been smart to come in with a differentiated product and unsecured product, partly out of they have to because they can't get a deed of priority easily from a bank, and partly because there's demand out there for that type of product. And that's allowed this market to evolve and develop. And I think the traditional banks have probably been a little bit slow to respond to how the other platforms have come into it.
Okay. Given that there are banks lending unsecured, there are platforms lending unsecured, they're differently regulated, obviously. Banks are going to have to take a fairly large capital charge against anything unsecured that they do. You guys don't. You've got small amounts of regulatory capital, but not much. How is this going to affect the balance of competition? I mean, I notice, for example, I look at the pricing on Funding Circle and on Esme, and they're pretty similar for the size of loan. You know, you pay roughly the same. But of course, they're regulated very differently. So how do the elements feed into the pricing for you, Richard? I mean, you're able, with a large capital charge from your fund provider, still to lend at rates that these guys do without that capital charge.
Yeah, and I think, but banks typically have to carry large amounts of capital to support the different products they have, but they also carry huge amounts of charges for the property, the staff, the systems that they have in place as well. One of the things that Esme does, which is a key for us, is the ability to harness the power of technology and the evolving technology, which is moving at a real pace, to manage your overall sort of cost-income ratio for your business, of which capital is just one sort of part of that. But being able to leverage automation is critical as part of your cost base, but also more importantly around sort of providing the customers with the sort of journey that they expect these days.
Yeah. So it'd be fair to say then that looking ahead, I could see a situation where the cost advantages you could get from automation could actually make you competitive with people on price that are regulated differently from you.
Yeah.
Right.
I think though when you look at organisations, institutions such as Lloyds, we are very competitive in terms of our cost of funding.
Of course.
We have a very large deposit book from which we can withdraw. We're a match book funding business, and we will continue to maintain match book funding. We also have a very competitive cost-income ratio. So we're not the Googles of this world that have a 10% cost-income ratio, but we do have a very competitive cost income at around 47% of the market. That's unlike other large institutional lenders. And that does give us advantage to continue to evolve and invest heavily in our own digital capabilities and to collaborate with other fintech. So I think it's simplistic to say that there is an agility within certain types of business model that does not exist in those institutional lenders. We've got to continue to push on those frontiers and continue to make that investment, but we do have a competitive advantage. And when you've got a book the size of one that is Lloyds at over 30 billion, you can take a portfolio approach in terms of that capital charge position. And again, with very low loss rates and really strong recovery rates, that's a very healthy position to be in.
Yeah. Okay. But of course, we are in a very benign credit environment at the moment. Default rates are extremely low. And also, interest rates on alternatives to investing with Funding Circle are extremely low. I mean, are you, at Funding Circle now, have you reached the point where you've driven down your sort of what you can do with the cost of funds you have? Can you do any better given your cost of funds, or is that actually going to take you back into loss? I mean, have you sort of hit the limits?
No, I mean, we've taken a very prudent approach to it, so we could easily drive the costs down much, much further. In fact, it has actually been lower in 2013 on our UK platform. But our view is, look, we're trying to show very good loss coverage on these loans. We're trying to go through a cycle, because we haven't been through a cycle. People like Lloyds, with a bit of help from all of us with our taxpayer money, got through RBS and Lloyds as well. But I think,
very good.
But I think we once we have gone through a cycle, there are lots of opportunities. And look, I get quite frustrated with this cost of capital argument because I see it, but then I also see that Lloyds at the end of the day and RBS have shareholders. And they have to generate a return on equity for those shareholders that is commensurate with the risk they're taking. Banks today trade at book value. So Lloyds trades at 1 times book value. RBS, unfortunately, is 0.6 times book value. And what that means is the bank is worth the equity that the shareholders have in it. they've put the money in, you could liquidate the bank and in theory, you're not going to be worse off. That's what the market is saying. So at some point, return on equity has to improve amongst major banks. It has to move to a higher level, and people have to be compensated for that. So that's the one argument around the cost of capital. The other one is we have lots of lenders through our platform, banks, for instance, insurance companies, pension funds, government entities that actually have lower cost of capital than banks. So it's not as simplistic, I agree, to say, there's one source and banks have cheap deposits. There are lots of different sources that platforms have. So I'm probably the last person making this argument anymore about the platform model, and everyone's doing some sort of balance sheet now. But in the long run, this model is a superior model, and it will win out. Let's see.
So, sorry, you raised something there, just for the sake of clarity. Never any balance sheet lending with Funding Circle, right?
Well, that's not what I said. I said we wouldn't become a bank. I think there are certain periods where balance sheet lending does make sense. I think that's really in the first 2 years when you're entering a market. We have seen across all of our markets, loans don't quite perform as well as we would like in the first 2 years. And I think what we've basically learned is that's just R&D. You need to be in a market, learning about stuff, really developing your credit models. I think in the early periods of a market, you do need to subsidize returns or do something for investors. It was fine when we didn't know whether or not loans would perform, but our view is in the first 2 years, you won't know until you've actually done some lending. But certainly going down, the bank route, I think is not something for us.
Righto. Well, we've been talking for a while, and we haven't mentioned the dread word technology very much yet. So what I'd like to ask then is if you can sort of look ahead a bit, because obviously there's a whole lot of stuff coming down the track which is going to make things very interesting. And where do you think you're going to get the biggest benefits from here in applying various sorts of technological innovation to what you do? Maybe Kim, do you want to begin?
So I think in terms of being a more connected world and a world of open banking, PSD2, I think more effective data, absolutely that's going to continue to push in terms of effective credit decisioning and being able to increase that speed of decision and the quality of decision. And that will, I think, also open up greater opportunities to clients in terms of the types of products that they can utilise. But I come back to this value add point. I think we've got to stop thinking about what the client wants in terms of a product lens. Clients need to think, we want to think about that end-to-end journey of what does the client want to achieve, what are we trying to help them do, and clients won't want, that lend because that's what they think they need. It comes back to what I said before, it's about how are we going to help them grow their businesses, how are they going to be better than their competitors, how can we help them find new markets. And that's where we're just as focused in Lloyds in terms of the types of tools and insight that we can drive. What can you push to the client in terms of insight that will be worthwhile to them to help them understand the problems that they don't have or they didn't know they had or the opportunity they didn't know that they had until you've exposed that to them, and being far more focused in terms of giving them that sector insight that goes alongside core financial service offerings. So I think that is a real opportunity for financial service providers, alongside creating fantastic and seamless experiences that enable them to deal with their bank or non-bank, how they want, when they want, and in whatever channel they choose. So for me, it's about broadening the value add to the client. We're going to have to earn the right for these clients to want to bank with us or want to do business with us. So we need to understand what it is, what value we can impart on them, not just that we can be there to draw down on the product.
Right. And Richard, I mean, you're on a voyage into technology now with Esme. Where else do you think it will take you?
I think it's, as you sort of roll it out, I agree with Kim. I think the banks and the platforms collate an awful lot of data from the customers and from the market. And I think utilising that data in a powerful way to play back to your customers and help develop new products, new solutions, provide sort of, help the customers with diagnostic tools to allow them to choose the right product for them at the right point in their journey, will be increasingly important. Creating ecosystems and sort of marketplaces as well, and helping the customer and the markets and business grow, I think, is where I see automation going.
And Samir, I mean, are you as a platform at any disadvantage theoretically to these guys because they hold a lot more data on a lot more companies than you currently do?
No, I don't think so. I mean, look, this trend of banks setting up platforms in SME lending is fascinating, and who knows where it's all going to end up. But we have an early example of that in Germany, where Commerzbank set up a new platform, and actually the loans have underperformed, and they've stopped reporting performance on those. So, a bank like Commerzbank has years and years of history and track record. We have been doing online lending to small businesses for close to 8 years now, and we've learned a lot of things. We've learned that different factors like channel, time of day, the way people interact with application forms, all of these things feed into the risk of lending to someone online. These guys are just starting their journey, so whilst we don't have a long history of data, I can tell you that I've seen some examples of banks where they have had that history and they haven't necessarily been able to translate it. So if anything, they have a disadvantage. Certainly when we've gone into new markets, we've sometimes overestimated risk in certain channels and underestimated. So that's one thing. The other stuff that's quite interesting, I think, is artificial intelligence, machine learning, techniques like that. Now, obviously, the banking system is very, very regulated, and that's right, because we're all on the hook. If banks go bust, we're basically standing there to bail them out. To what extent are regulators really going to allow large institutions like Lloyds, RBS, to really make use of these very innovative techniques like deep learning? So I'm not just talking about traditional machine learning, but real deep learning stuff. My bet is they're not really going to be very comfortable with it. They're actually going to say, look, that needs to happen in a less risky part of the system. And that's why you tend to have quantitative asset managers. You don't tend to have quantitative principal trading books or things like that in banks anymore. So over the next 5 years, as these techniques and tools start to become much better used, I think platforms actually have a massive advantage over the banking system, which it'll be interesting. Now, how much of an alpha that gives versus traditional credit scoring techniques, I don't know. But certainly when we've been applying these techniques in other parts of our business, like sales, contact strategies, marketing, we've seen massive uplifts way in excess of what we could achieve if we just had, frankly, more data. So, far from being at a disadvantage, I think as we enter a world where artificial intelligence, all these techniques are going to be used much more widely, where people are used to interacting with services as an app on their phone. Is your bank really your finance folder on your phone, where you've got, I don't know, making up Esme maybe for SME lending, hopefully Funding Circle instead, TransferWise, things like that, where you take the individual components of a bank and you do them super efficiently and you're 1 or 2 clicks away. Or is it actually, you're still going into branches, you want the relationship, you want someone trusted to explain everything. I mean, it's probably going to be a bit of both, but obviously our wager is that that first world I described, the app on your phone, being specialist at one thing, doing it really amazingly well, is actually going to be a really big part of the market.